Buying a home can be overwhelming. In this video, I'm going to be breaking down each step of the process and exactly what to expect. Hi there, my name is Albert. I'm a real estate agent in the Lancaster and York, Pennsylvania area. And over the last 2 years, I've helped over 40 families purchase their next home. In this video, we're going to start right at the beginning from looking at that first home on Zillow, going all the way through to getting those keys in your hands on closing day. I'm also going to include a link in the description below to my home buyer guide. I would also suggest that you subscribe and like this video. That way, as you go through each step of the process, you can be referring to this guide. Let's get started. Now, I would say the majority of people skip the first step of the home buying process, myself included. They head straight onto Zillow and they start seeing when they can take a look at homes. In all honesty, before you start doing that, the best thing to do is to speak with a lender and make sure you have your financing in order. What this means is you're going to want to speak to a local bank or credit union and see if you can get yourself pre-qualified or pre-approved for a mortgage. A pre-qualification is an estimate of what a lender or a bank thinks you may be able to borrow based on self-provided information. Typically, when you speak with a lender, they're going to ask you for a couple of W-2s and roughly what you earned in the previous calendar year, any debts you may have, and then from that, they're going to give you an estimate of what you may be able to afford. A pre-approval, on the other hand, is when they take a deep dive into your finances, looking at bank statements, W-2s, tax returns. They're also going to pull your credit to see if you have any outstanding debts and what your overall financial picture looks like. Typically, what you're going to need is the last 2 pay stubs, so 30 days of pay stubs, 2 years of tax returns, especially if you're self-employed. They'll do a credit check, and they'll also want a couple of months of bank statements. Now, I would recommend using a local lender or credit union. Some of the larger national companies can be very slow to respond to you and tend to make mistakes on the estimated closing costs, but more on that later. You may also find that some of the local banks and credit unions have local incentives for you, which can help reduce your overall closing costs or give you money towards a deposit. So what can I afford, I hear you say? There's a very quick way you can find out approximately what you may be able to afford, but I always recommend you speak to a lender because they're going to be the ones approving you in the end, so you may as well know exactly what your budget is when you're starting out. One of the easiest ways to start out is finding an affordability calculator like Zillow. You go in there, you're going to put your annual income, that's your gross income before taxes, your estimated monthly debts, however much money you've got saved for a down payment, and it will give you a rough number of what you should be able to afford. For example, if you had a household income of $2,500, monthly debts, that's credit cards, student loans, car payments, etc., of $250, a down payment of $25,000, then you may be able to afford a home in the sort of $200,000 to $275,000 range. Now, if you see here, you adjust this slider. This adjusts something called your debt to income. If you took your entire annual salary, divided by 12, that gives you your monthly income. And then whatever your monthly payments are towards debt, that as a percentage of that income is what your debt to income ratio is. Lenders will have limits of what they're going to lend you. Let's say you earn $1,000 a month. If you have debts of $600 a month, it's unlikely you're going to be able to qualify for any mortgage at all. A good rule of thumb is you don't really want your housing to be more than 28 to 36% of your overall gross income, else you may find your budget gets stretched a little bit. Now, if you're in an area that has lower taxes, you may be able to borrow more money because you look at the overall monthly payment as a percentage of your income. But in this example, we can borrow around $259,000, staying within that 36% debt to income ratio. So for the rest of this video, I'm going to use this property as the example based on what we know we can afford from our affordability calculator. Obviously, we'd have that verified by the bank. And this is a 3-bedroom, 1-bathroom property in Lancaster, Pennsylvania on Maple Avenue. Now, I'm going to break down exactly what's going to be in that monthly payment, as it's not just the mortgage interest in principal. You also have to think about property taxes, home insurance, and if there's an HOA, that will be included as well. Using 1188 Maple Avenue as an example, we have a sale price of $250,000, and I'm just breaking down the payment right now, but we will come back here towards the end when we talk about closing costs. If we were putting 3.5% down, we have a principal and interest of $1,471. The real estate taxes on this property are around $4,200 a year, so that's $355 a month. Home insurance, I'm budgeting around $1,250 a year. And because we're putting less than 20% down, we are going to have something called mortgage insurance. And again, depending on your credit score, but we're going to estimate about $110 a month for this, which would give us a monthly estimated payment of $2,042. That means if you have little to no debt, that does mean you are going to need to have an income of around $65,000 to $80,000 a year as a household. Now let's look at the different types of loans and how your credit score may impact which loan will be right for you when you're looking at purchasing a home. The lower your credit score is, the less options are going to be available to you and the higher interest rate you're going to pay. This is because lenders are going to see you as a higher risk, so unless you're putting more money down, it's going to be less likely for you to qualify for the home that you would like, or you're going to be paying a premium in order to borrow that money. Most likely, you're going to be using one of the following loan types. You have an FHA loan. This is a 3.5% down payment loan. It's backed by federal programs. You will have mortgage insurance that will pay for the life of the loan, but you are able to qualify for this with a lower credit score, and it will lend you up to a higher debt to income. Not that you should borrow more just because you can. So as long as you've got a credit score of 580 or above, you should be able to qualify for FHA. Next up, you've got a conventional loan. So if your credit score is a little bit higher, typically 620 or above, you may qualify for a conventional loan. On a conventional loan, as a first-time home buyer, you can put down as little as 3%. I would recommend either doing 3%, 5%, or potentially 20% if you have a big enough down payment. At 20%, you won't have to pay mortgage insurance. And the good thing about a conventional loan is even if you put less money down, when you hit 20% in equity in your property, you will no longer have to pay that mortgage insurance, which can add up to hundreds of dollars off of your overall payment. If you're a veteran, first of all, thank you for your service. Then you may be able to put 0% down. And again, these programs allow you to have a lower credit score, and you're also able to roll more of the fees into that loan, which means you can close for a lot less money. Another low or no money down option is USDA. Now, USDA does have restrictions on the areas that you can use that type of loan, and also has income restrictions. You may find your local credit union or bank has some other options available to you. I've had a few buyers go through Fulton Bank. They have a wonderful 0% down conventional program with no mortgage insurance. You do need to have a higher credit score of around $680,000, and you can't earn more than $84,000 a year. Now, what strategy is right for you? Now, depending on your income and your job and also how much reserves you have, you may find that if you have lots of money to put down and you're going to have plenty of reserves afterwards, then I would recommend going with the 20% down option. My wife and I, we were buying a bit of a fixer-upper property. We wanted to make sure that we had enough money in our bank in order to do those repairs. So we put 5% down, which means we were paying mortgage insurance. But once those repairs are done, we're going to get an appraisal on the property, and we should have more than 20% equity, which means we will no longer have to pay that. If you're very limited on down payment, you may go for one of the 0% down options, like I mentioned from Fulton Bank. Now, the risk with this is if you did need to sell in a short period of time, you may not have any equity in your home. Equity is the difference between the value or the sale price of your property and what you currently owe on the mortgage. So if you did need to move, you may not actually be able to sell the home. I would say go with either the 0, 3, 5, or 20%, and then whatever leaves you with enough reserves to feel comfortable. Now, the final thing before we actually start looking at homes is going to be those closing costs. Going back to my buyer estimated closing costs, we have the property address, 1188 Maple Avenue. We have the sales price. We have a settlement date, which is the end of September. Typically, your closing would be about 30 days out. We have the annual taxes for that property. We have an interest rate of 6%. And then we have the type of loan, our down payment, and then what our mortgage amount is going to be. Now, on top of that 3.5% deposit, there are also going to be additional fees that you will need to pay at closing on the property. In Pennsylvania, we have a 2% transfer tax. 1% is paid by the buyer and 1% is paid by the seller unless otherwise negotiated. That means on this home, you would have transfer taxes of $2,500 to pay. Other closing costs, depending on the lender, you're going to have these origination fees. I'm just putting in a few ballpark numbers here based on some cost sheets that I've had recently. But let's say the origination fees of around $1,500 to $2,000. There's something called mortgage discount points, and this is where you can pay some money to help get you a better interest rate. So a percentage of the loan, you would pay that as additional money up front, and that would help reduce your overall interest rate. An appraisal. So you'll have to pay for appraisal, and if you're able to get a home inspection, you'll pay for your appraisal and inspection up front. And your appraisal typically is going to run you somewhere between $500 and $800, depending on the company. And a home inspection may run you somewhere from $300 all the way up to $1,000, depending on what you're getting done. Then there are smaller fees, such as your credit card report, underwriting, flood certificate, courier, wire. And not that you need to necessarily understand exactly what all of these are right now, but just be aware that there will be these additional small fees which do add up. The other big fee to think about is the buyer agent commission. Some agents may charge you 1%, others may charge you 3.5% or 4% for a buyer agent commission. If you have a good agent, you should be able to negotiate the seller paying some of those fees for you, but it's not always a guarantee. If you look on the right-hand side, we have the transaction summary. This includes all of those lender fees, prepaying taxes for the following year, reimbursing the seller for taxes that they've already paid, also things like agent commissions, origination fees, and any other fee basically associated with purchasing the home. We have lender escrows. This is where they take a percentage of the predicted taxes for the next year, home insurance, etc., and take some of that money to fill that account. And then the reimbursements to seller is just any taxes or fees that they may have paid for like township sewer, trash over the past year that you're reimbursing them for. So you can see on this property, even though our down payment would be $8,750, we have around $16,000 of closing costs, $3,000 of reimbursements to seller, and $2,000 of lender escrows. This means our total estimated cash to close is going to be around $25,000. And then underneath is that monthly payment that we spoke about earlier. Congratulations. If you're still sticking with me, then you managed to survive the very boring but very important financing side of the purchase. This is going to be one of the biggest purchases in your entire life, so it does make sense to spend the time to really understand the numbers, know what your budget is, so you feel confident and comfortable when you go to purchase that home. Now, you may have done this at the same time, but your next step would then be to find yourself a local real estate agent, someone like myself, who knows the area well. They may also have some recommendations for lenders and banks. And obviously, if you are looking at purchasing a property in Lancaster and you'd like to learn a little bit more about the buying process one-on-one, please do click a link in the description below and you'll be able to fill in a consultation form on my calendar, and I'll be more than happy to take you through it. Moving swiftly on, so we found our lender, we found our agent, and now it is time to finally start looking at houses. Thank goodness. Now, when you're going out to look at a home, I would suggest that you sit down and write your absolutely non-negotiables and what that home is going to look like. I would write down your top 3 areas that you're hoping to be in, what type of home, whether it's a split level, a rancher, or a townhome, whether it's an old home or a new home, number of bedrooms, whether you want a garage or not, and then pick your absolute non-negotiables from this list. Once you've done that, speak to your agent, give them that criteria. They will be able to run a search for you. If you're looking for some inspiration yourself or ideas that you want to send to your agent, then you could head to a website like Zillow or homes.com, type in the address, Lancaster, Pennsylvania. We've got a price point up to $250. We know we want at least a 2-bedroom property, let's say, 1 bathroom, and we don't want a condo, but we want something that's a home or a townhome. And then you'll be able to see on here, there's a couple of different options. You can scroll through, see which ones take your fancy in the areas that you want to be in. You would click on them, send them to your agent, and then they would be able to get you a showing. I would advise going in looking at 2 to 4 properties. That way you can get an idea of different properties out there, but you're also not going to overwhelm yourself. Now that we found our property, it's time to write an offer. And depending on the home and how competitive it is, that is really going to impact what you put into that offer. These are the things that you can negotiate or adapt in your offer to make it more attractive to sellers. First of all, we have the price. Obviously, the more money, the better for the seller. Number 2 is inspections. So the more inspections you ask for, the more risky it's going to feel for the seller. That isn't necessarily saying that they're hiding something, but if they're looking for a quick sale, they're probably going to take an offer with fewer inspections or no inspections, rather than a slightly higher purchase price that has lots. As a first-time home buyer or any home buyer, I always recommend you get a home inspection if you can. But in this crazy Lancaster market for the last couple of years, it has been very difficult to get home inspections. My wife and I ended up waiving them because there were 3 other offers and we had to be competitive and we knew we wanted the home. If you don't want to go straight in at a higher price, you can do something called a price escalation clause. This is where, let's say you wanted to offer $240 on this home because there's no other offers. But if another offer came in, you could do a price escalation up to X amount of dollars, let's say $260,000 in this case, and you would go up in $4,000 increments, which meant if someone had come in and offered $241,000, your offer would then jump to $245,000. This means that you don't necessarily have to overpay for the property. This means you don't have to go straight in at that top number, which means you could get a bit of a deal. However, if someone else came in, it still keeps you competitive and could win you the home. But when you buy a home with financing, you are going to have to get something called an appraisal. This just means the bank is going to go out there and make sure the home is worth what you're hoping to borrow on it, because the bank doesn't want to lose money, basically. Let's say the property, we've offered $250, the appraisal comes in at $250, no worries, we're all good. The bank is going to lend us the money, we have our deposit, fantastic. Let's say the property appraised at $240,000. Now, you would even negotiate with the seller to get a price reduction, but we could also say, to be more competitive, we will do a $10,000 appraisal gap, which means if it appraises anywhere from $240 to $250 or above, we will then buy the property and we would pay the difference between what the property appraised for and the purchase price. So for example, if it appraised at $245, we would bring an extra $5,000 towards the closing table. Next up is being flexible with the closing date, especially if you're a first-time home buyer. Good news is you don't have a home to sell. This can make you a lot more attractive to a seller who doesn't want to have to worry about someone else having to sell their property before purchasing the new one. Also, if the seller needs more time in their property, something like a rent back or being able to give them an extra 30 to 60 days in their home could also help you win the deal. The amount of deposit that you put down. Now, this is a good faith deposit or an EMD, and this is a deposit to show the seller that we're serious. This is slightly different to the deposit on the actual home itself, but we can basically say to a seller, hey, look, I want to give you $5,000 as a kind of, I really like your home, I'm not going to back out, to show that you're serious about purchasing it. That's just to stop you from getting cold feet and say one day before closing going, actually, you know what? I don't want to buy it anymore. So the seller would then keep that money unless you had various contingencies in place. So the bigger your deposit, the more serious you're showing you are about purchasing the home. You also show that you have funds available to close on a property. So the seller may see you as less risky as someone who's putting less money down. And finally, waiving inspections. Like I said, the fewer inspections you had, the more attractive your offer is going to be. However, the less protected you are. Now, waiving all inspections can be risky, but you could set a cap on the minimum amount a repair would have to cost before you would ask for any money back or to get it fixed. For example, you may say, we're not going to ask for any single item that doesn't cost more than $2,500 to repair. And this means you're basically focusing on larger items like roof, HVAC, potentially a water heater, and any structural issues. Speaking of home inspections, next up on the list, our offer has been accepted, and now it is time for our home inspections. Let's fast forward and say we've had our offer accepted. First of all, congratulations, and now it's time to get ready for our home inspections. Let's say we've had our offer accepted, and we do have an inspection included. We will have typically between 10 to 15 days, longer if you write it in the contract, to get all of those inspections done. If you don't manage to get them completed within the time, then unfortunately, you will not be able to use that to negotiate on the property. My recommendation would be to order your home inspection as soon as you go under contract. And also, once you've had the home inspection back, read through it thoroughly, speak with your agent, speak with maybe a contractor if you have one, and see if you want any repairs doing. Make that list, and you can ask for either a credit for the repairs to be done, or just agree to proceed with the property as it is. There are multiple different types of inspection, but the main ones are a home inspection, mold inspection, septic and sewer. You may also have surveys done. You could also have a structural inspection as well. An inspection is probably going to run you somewhere from $350 all the way up to $1,000. If you're having multiple inspections done, it's definitely going to be on that higher end. And what I would say is an inspection is not an excuse to get out of the house for no reason. An inspection is to see if there are any major items that may not have been disclosed or you may have missed when walking through it, and you want to get those resolved, or some money in your back pocket in the forms of a credit from the seller in order to be able to get those fixed so that you're not going to be the one fitting the bill. Sometimes you can't come to agreeable terms with the seller, and then you would be able to terminate the agreement, at which point you would get your deposit back if you had an inspection contingency in your contract. Once the inspection is done and the appraisals come back all good, you're probably on the home straight. I would recommend doing a walkthrough the day of your closing just to make sure the seller hasn't taken anything out of the property, that no damage has been done since you last saw it. And then that way, you would then get this signed off at the settlement table. You transfer the money and you would get your keys. But before we get those keys and move in, here are a few mistakes buyers often make. Now, buying a home can be very exciting. You start thinking about all the furniture and painting and decorating you're going to do. Once you're pre-approved and you're getting serious about purchasing a home, do not do any of the following. Do not open or close any credit cards. You do not want to do anything that can impact your credit score. Continue to make your payments on any cards and loans that you have, but do not open any new ones. Do not buy any new furniture or a car until you have the keys for your home. Any major purchases, could eat into that deposit money that you have, or if you accidentally end up signing up for a new credit card or someone runs your credit, it could actually cost you being able to purchase the home and you may lose your deposit. Try not to move money between the accounts, especially if you have money coming in that isn't from your normal W-2 or self-employed income. Any large deposits, and a large deposit could be anything $250 in cash from a birthday, you're going to have to account for every single dollar that you're going to be using to purchase the property. Do not make the mistake of making any large deposits or transferring large amounts of funds or even relatively small amounts of funds between accounts. Do not change your job. If you hate your job, please do not go and quit 2 weeks before the closing table. We've seen it happen in our office, and guess what? You get there, if you mention it, you won't be able to get the loan because that's how the lender was going to finance you in the first place, and you will not be able to purchase the home. Make sure you fill all of the loan documents in properly and thoroughly and provide all of the information to the lender as quickly as possible. Will they ask you for the same information multiple times? Yes. It's annoying, it's frustrating. However, just get it over to them. It's the biggest purchase you're going to make for probably the next 10 years. And if they're being annoying, just roll your eyes and send it over to them again. If you're building a new construction home, the process is ever so slightly different, but ultimately you would still start off by getting financing. You'd go to a builder, find a lot, put a deposit down on the lot, go to the builder, pick your options for the home, and then you would wait your 6 to 9 months or a year, however long it's going to take to build, and then you would get your final financing at the end. Now, slight differences with new construction is the transfer taxes are typically paid different. You will pay the full 2% of the transfer tax rather than 1%, so that'll be additional closing costs for you. Builders do sometimes offer incentives. For example, I recently had a client who's purchasing a new construction property in Dover, and they were able to get $17,000 in incentives from the builder for using their preferred lender and title company. The biggest thing to watch out for, especially on new construction, is going to be A, those closing costs, and B is the property taxes. If you're trying to run numbers to find out what your monthly payment is going to be, make sure you speak with the builder and the township as to what the actual estimated property taxes are going to be. The mistake a lot of people make is when purchasing a new construction property, the taxes will just be for the land. So let's say it was $1,000 just for the property taxes for the land. Now, once the house is built on it, those property taxes could easily be $5,000, $6,000, $7,000, $8,000 a year. This means if you've run your numbers for your monthly payment on $1,000 a month, you're actually going to be in a real shock when it comes around to the following year, once the home's been built and that tax bill comes due, because you could find your payment jumping up by $600 or $700 a month. So make sure you speak with a lender, you make them aware you're purchasing a new construction property, and you get as accurate as you can, or if anything, overestimate what you think your property taxes are going to be, so you don't end up being in real trouble when those property taxes go up once the home has been built. And what is the timeline from going under contract to closing? So if you're cash, you can probably close in as little as 10 days and then be as flexible as you want after that. If you're purchasing a conventional financing, you may be able to get it done in as quickly as 3 weeks, but typically we say around 30 days to 40 days. And if you're doing FHA or VA, because they're a little bit stricter with their appraisals, you may have to get some repairs done. So we recommend 45 to 60 days for an FHA or VA deal. On that final walkthrough, make sure you check all the repairs that have been done, all the appliances are there. And when you go to closing, make sure you bring an ID that hasn't expired. Make sure you've either wired the funds or have something called a cashier's check for the bank for the final number. And typically you would get those final numbers 1 to 3 days prior to the closing. At the closing, you'll sit there and sign for about 100 pages of documents, but once that's done, you will finally have your keys. A few final things to think about is you will have to get the utilities set up on the property, so make sure you have the electric, gas, whatever types of utilities you have on that home set up for the day you move in. I would also recommend changing the locks, especially if it's an older home, you have no idea who has a key to the property. And make sure you get your mail forwarded from your previous address to your new address. Now you can take a deep breath and relax. You've made it through to the end. I hope this guide has made you feel a little bit more comfortable about the home buying process. It is an awful lot of information. So like I say, focus on one section at a time. And if you are looking for someone to help you guide you through this process, or even looking to purchase a home yourself, do book a one-to-one consultation with me in the link below. I also have my downloadable free home buyer guide in the description below. And if you have any additional questions, please drop them in the comments below and I will respond to absolutely every single one of them.